Hello, everyone. This is the Keeping It Real in Real Estate show, and I'm your host, Kathy Blakey. I'm a realtor with Century 21, a marketer, entrepreneur, and nature enthusiast. In this podcast series, I'm going to take you on a journey as we explore topics in real estate, including the market, mortgages, common inspection issues, sustainable future, and more. Are you a homeowner? Future homeowner? Do you like saving money? Enjoy healthy living? Then this podcast series may be for you. Stay tuned as we go deep into these topics. And don't forget, subscribe, like, and share. In this episode, we're going to be talking about new construction financing. Maybe you've been looking for a house for a while, existing homes, and you're just not finding the right home for you. Or maybe it's been your lifelong dream to build a new construction home that fits your specifications and what you really want out of a home. Whatever the case may be, stay tuned for this episode while we take a look at some financing tips that may save you thousands of dollars. So today we're going to be talking about some of the unique differences when you're purchasing a new home and the financing that goes with it. Joining me again is Bernie Doherty from Pike Mortgage. He's been on the show before on episode number 2. But Bernie, for the benefit of this audience, do you mind just giving us a brief introduction?
Yeah, no problem. Business, 21 years. With Pike Creek Mortgage, 11 years. I should probably tell you my NMLS, which is 146770. I was an instructor for the Delaware Association of Realtors for 5 years so they could obtain and maintain their licenses. And it's nice to be back. Thanks for having me.
Thanks, Bernie. Glad to have you back. So you do a lot of new construction financing, so I'm sure you've seen a lot of different circumstances. But one of the things that I think about, and I get a lot of questions from buyers, is what happens if the interest rate changes? When should we lock? And, what other things should we be thinking about because the time between contract to close is so long?
So it's actually one of the first things we start to talk about even during the pre-qualification is that when you're buying new construction, you're basically purchasing some uncertainty. The builder has generally not started the house yet. They haven't pulled permits. They have not dug the hole. So essentially, you're stuck on weather, also on how long it takes the town to pull permits. So these items could, give you an idea of a settlement date, but they're not going to give you something firm. That being said, it's challenging to tell you what your interest rate's going to be at that time because you're subject to market changes. Now, what I will tell you is that you can do a long-term lock. However, meaning use today's interest rate and lock it for a long term, meaning 6 months, 9 months, 360 days. But they're very expensive. So, for example, the long-term lock for 180 days, which is almost 6 months, is 1.125% of your loan amount. Well, if you're buying a $300,000 house or you're mortgaging $300,000, your fee alone is over $3,000, and that's just going towards the rate. It is non-refundable, and it is just an extra cost that you incur. Generally, what I find is people look to lock within the last 60 days. What that means is pre-drywall inspection. What you're looking for the builder is to hear the term pre-drywall inspection. That means you're going to do an inspection that's inside the house, obviously, but that means they're done the outside of the house, so they're not worried about weather. So they won't have that problem. So now that they're in the house, they generally give you a settlement date at that time or somewhere in that time period. Most builders are going to be pretty close. Now, what I'll tell you also is you're responsible for your lock. If the builder is late by a week and your lock expires, any extension fees would be applicable to the borrower themselves. So if they give you a, June 30th settlement date and we're here May 23rd, okay, you lock a loan for 60 days, lock an interest rate for 60 days, and you should be good. Okay, now, one of the big questions is, what if I lock my interest rate and rates go down? Most lenders offer what's called a float down. What is needed for that is you have to be within 30 days. The interest rates must have improved by at least a quarter point. Now, we use quarter point, but the real benchmark is basis points on how an interest rate is determined, and it's 100 basis points, which generally means 0.25% better in interest rate for you. So if the rate is better by a quarter and you're within 30 days of settlement, you have the ability to renegotiate your interest rate, and generally speaking, a lender will be able to help you out with that.
Now, is that something that you might know up front when you're first applying for your mortgage? How does one go about knowing that their lender will offer that?
It's definitely a question to ask. It's something that's part of my protocol and having that conversation with them, especially in the beginning, because if you're trying to make a budget on how much it's going to cost, you want to make sure that they're aware that, your rates are subject to change, because as the markets move, so will interest rates. Most people, and I'm going to say it's very few people that I've found, have done a long-term lock because they don't have the additional money sitting around. And also, when you're doing new construction, the builder generally accepts a very large deposit, sometimes 5% of the base price of the home. Well, if you're giving that much money, most people don't have the money to lock the interest rate as well, because it's an additional cost.
So, Bernie, you were just mentioning that a builder might require a pretty substantial deposit along the way. They may require even 10% before you get to closing, but yet you're only using a 5% down payment loan. What do you do with the other 5%? Explain that to us.
So all money deposited with the builder is for the builder's protection. Now, it is credited towards the mortgage portion at the end of the transaction. So if you're only putting down 5%, or you're doing a USDA loan or FHA loan, which requires even less of a percentage down, that money would flip over into any closing costs that are associated with your purchase at that time. Now, it does happen where if you've given more money than what is needed, you will get your money back.
Yeah, that's what I wanted to make sure of, because nobody wants to give 10% and only need to give 3% and wonder where the other 7% is going to go.
Absolutely. I've seen as much as $6,000 or $7,000 given back to the buyer at the time of settlement. And it's important, you're getting back your money that you put into the transaction. Okay. So you can't finance extra money and then get it back. No, it's your money that's into the transaction. As long as closing costs are paid and the down payment is met, any additional money you would get back at that time.
So it's kind of as if, the money with the builders just, held in escrow, and then what you do with that once you get the settlement is applied to your financing terms.
That's correct. It's definitely for the builder's protection. Make sure that you're in, and if something were to happen, they have the money.
All right. So from the time of the contract is taken for a new construction home to the time of settlement, sometimes it's 4 months, 6 months is probably more typical, or even 9 months. A lot of the buyer's financials could change during that time. From a lending perspective, Bernie, what recommendations do you have for buyers?
So it's extremely important to have the conversation and making sure that everybody's aware of their current financial situation. Now, in a lot of cases, people don't have all the money saved up yet. So we want to make sure we have a goal of how much money is needed at the time of settlement, so that way they can save. And remember, the builder has to be comfortable with how much they're going to save. Sometimes the builder will take deposits throughout the course of them building, because they want to make sure that there's money accounted for. Sometimes credit scores, you want them to rise. Sometimes you have a high debt to income ratio, so you want to monitor how much debt you have, and then make sure we have, because if interest rates change, make sure we have, the ability to go to settlement. So a lot of it's about protection. You don't want to build a home and then find out you can't actually buy it. But the important part is, a buyer's responsibility is 3 basic items: income, assets, and credit. So the income is generally pretty set. The assets, obviously, we can save money during this time period. My biggest part is the credit. What can we do to improve it? Now, in the 6 months, 9 months, in that range can really be beneficial to someone who's been struggling with credit, has weak or low credit, and we can devise a plan to make sure that we get their score higher. In one case, we had a guy go from 620 credit score to a 719. So not only did it improve interest rate, but it also changed the type of program that he was going through, which obviously saved him money. So it was a real benefit for that time period for the house to be built, because he could still qualify when he started the application. But by the time we got around to the purchase of the home, the actual settlement, his financial picture was so much better, and it was made it much cheaper for him.
Okay, so it sounds like all the work that a buyer does to get ready for a pre-approval doesn't actually stop when they go to contract. Keep that up and make good continuous progress, and that can only benefit them from the interest rate.
Absolutely. And staying in touch. Should a question arise, don't make assumptions. Reach out to your loan officer, make sure they understand. Sometimes, things come up, and let's say, for example, a car dies, or, something along those lines. We want to make sure that discussing the procedure on what the debt ratio could be, and the effect on credit by opening up a new trade line could have on the purchase of their new home. You have people who get a little excited and want to go out and buy their appliances because it's Memorial Day weekend.
Oh, no.
Do not do it. If you don't have a house to put the appliances in, you don't need the appliances yet. So wait till you have the keys to the house and then start purchasing things for the home. I understand the deals, but at the end of the day, the most important part is getting the keys to the home before making any purchases for it.
Now, what if there's a great job opportunity that you just can't resist?
That's okay. That's okay. Once again, you want to review that and also the timing of it. Is it 2 weeks before settlement? Is it 3 months before settlement? That part's important because depending on the type of loan that you're getting, some loans require a 30-day pay stub. Well, if you're closing 30 days from now and you're starting a new job, you're not going to have a pay stub referencing 30 days in that time period. And also, it depends on the type of work as well. So if you're going to stay in the same line of work, yes. A lot of times it's not a problem because people don't generally go outside their current line of work. So they'll stay linear. They'll go directly to just a better opportunity, more money, closer to home, things of that nature. That's okay, but the timing is also important. So if you're not settling to December and it's now May, that's okay. And make sure one part's very important. If you are a W-2'd employee, you'll be fine, but you have to stay W-2'd employee. If you are going from W-2 to a 1099, you become self-employed and you no longer have an income. It will not qualify.
Ooh,
if you go to commission, once again, it will not qualify if you're switching from W-2 to commission and you're looking at a settlement in the next 6 months. They're not going to count your income.
Yeah, I could see how that would be something that a lender could be concerned with because you don't have that history there as a 1099 employee or self-employed employee.
Commission as well, because you're considered now self-employed and they're not taking taxes out in some cases. Others, you're on your own to make your money. So therefore, they're going to require a history of that. A self-employment history is going to be 2 years on tax returns. Commission can be done with 1 year, but once again, it's going to need to be on a tax return. If you're settling in December and you switch from W-2 to some alternative type of employment, you're not going to be able to get the settlement in December.
So it sounds like the things that people do to get pre-approved, like having good income, solid assets, and good credit score, those are the three things that they want to continue to focus on throughout that extended period from contract to close.
That's their general responsibilities. And then once again, the types of income, as long as it's W-2, you want to be very, once again, linear. You want to stay focused on exactly what's going on, not to make too many changes on how you're going about life over the next little bit here, because the eye on the prize, you want to get to your home. And if your financial picture changes, which sometimes life happens and there's nothing you can do about it, but you want to be upfront, because remember, a builder is building your home to your specifications, your flooring, your countertops, your cabinets. They do not want to resell this. They also have your money. So if something happens that you could have prevented, they may keep your money. So it's important that you have a good conversation, you know your financial picture, you talk with your loan officer, good set expectations, and you maintain the stability of your life. Remember, they're approving you for your financial situation in May. If your picture changes in September, that approval may not hold water any longer. So you want to make sure that it's clear with your lending institution of what's going on.
So kind of along those same lines, what do you recommend for documenting any changes? So for instance, this is again an extended period of time where the money for the builder is moving, from your account to the builder's account. Tracking of deposits, tracking of, say you've got, friends, relatives that are, giving you extra money throughout the process to help you with your savings. Is there any recommendation you can give for buyers to track their money through the process?
Simple is better. So if you've got money coming in, do not have it being transferred over to 6 different accounts. Obviously there's Christmas clubs and 401ks and IRAs and savings and checkings and things of that nature. All that is fine to do, but it has to be documented by bank statements. So, just imagine getting every month, if you have 4 accounts, make sure you're getting that bank statement and sending it to your lender for that, for the next 6-month period. 4 times 6, you're looking 24 statements that you're going to send. So you're just creating more paperwork for yourself, which is okay. Just know that ahead of time. Now, as far as getting money from other sources, you got to clear it with your loan officer to make sure that it's an acceptable source. It's amazing when people are under contract, they start selling things, stereos, cameras, lawnmowers.
Good point.
And when they get these types of money, they have to be able to track it. If there's no sales receipt, if there's no actual documentation and it's just cash, there's a possibility they're not able to use that towards the purchase of their new home, and it's going to be backed out.
That could be almost devastating. If sell a $5,000, car or something like that you plan to use. So what do you recommend? A bill of sale?
Well, yeah, absolutely. A bill of sale, a check. It's got to be signed by both parties as far as the bill of sale, and then a copy of the check itself. any type of records from the DMV and the cars,
right.
Things of that nature.
Car, it could be jewelry, it could
Absolutely.
be anything.
If you sold something over some sort of website, eBay or something along those lines, you're also going to have to print that. So, it's important. Now, also the transfer of money from gift sources. Once again, it has to be an acceptable source of gift. You have to be a relative, or there has to be a relationship established that we can prove. You can't just have Bob off the street hand you $5,000 because guess what? They may not count that money. We have to be able to prove who Bob is in relationship to you. So once again, it's important for complete clarity. We need to be very clear on what's going on, where the money's coming from, and not make assumptions, not just to say, oh, I just thought having the money was okay. It's not. We have to be able to prove where it comes from, which causes more documentation and sometimes some stress.
Okay. All right. Another important consideration for new construction financing. So I'm going to switch gears and talk about the appraisal. So from a buyer's perspective and from a lender's perspective, this house isn't even built yet. How do you issue a mortgage approval within, I guess sometimes it's 30 days even? How does a lender issue a mortgage approval with a house that's not quite built yet?
So with new construction, then generally you're not ordering the appraisal until that pre-drywall inspection that we spoke of earlier. They're going to wait till there's walls, and they're going to wait till they have the lot and it's dug out and the permits and all the specs and plans and all that stuff is in place, as well as any addendums. Remember, when you go to contract, you're doing your selections, but you may not have picked out your flooring. You may not have been specific enough about your fixtures, your cabinets, things of that nature. So those things can add value to your property. Obviously, the number one item is the square footage of the home and the neighborhood it's in, but anything that you've added, a sunroom, a finished basement, these items in which you may have added later on down the road may not be referenced in the original.
Well, that's a really good point, because I don't know that everyone, once you hand over a contract to the lender and said, hey, get started on my loan, we may not be always thinking about the addendums and the tile flooring and the granite counters that we've added afterwards.
Absolutely. It's rare that it starts with specs and plans. It's rare that someone comes in with an application and their selections and blueprints and an appraiser goes off of that. Has it happened? Absolutely. But it's not that common any longer, especially for a property that is being built by a builder. And I don't mean spot building, meaning that if you have... When we deal with new construction, it's different than construction to perm. Let's make sure that we're clear on that. Construction to perm is you own the land, you hire an architect, you hire a builder, and then you're doing a loan in order to fund the different stages of the building.
Oh, wow, Bernie, that could be a whole other topic for us.
That's a completely different thing. When we're dealing with our conversation for today, we're talking about new construction, in which case you went into a development, you went to the house, the site house for them, you picked out a particular model home, and you picked out all your specifications. Now the builder's building it on their dollar, and they own the lot, they own the land, they're building it. You're giving them a deposit. That's what we're focused on here today. Now, that being said, when you go back to the appraisal, it's very rare in that case, in this particular case, that we're ordering the appraisal up front. You're usually waiting until you get to that pre-drywall inspection. You're ordering the appraisal at that time. Now, it's helpful because anything that has settled in that development that is of like for that particular property then becomes a comparable property. And in a good market where things are appreciating, that could make the value even better. Even though you've set your mark for your purchase price, if things are appreciating, hey, listen, at times, things can come in higher on appraisal because comparable properties have settled. So in saying that, though, there is such a thing as over improving a home for the development. Now, new construction, from time to time, we put all the bells and whistles into a property. The problem with that is you can over improve a property for the development's value. It's very important for the builder to let the buyer know that, hey, this house may not appraise for what it needs to appraise for. It may be undervalued because you put too many options. Sometimes they're custom, sometimes they're just options. But if you put too much stuff into this home, it may not appraise. And the buyer is responsible for the difference. So if your purchase price is $350 and it only appraises for $325, you're responsible for that $25,000 first, and then your loan percentage will begin. So if you're putting 10% down, you put 10% down off of $325, but you still owe the other $25,000 because the purchase price is $350. Now, one thing I want to draw a connection to on that is this also comes into the type of financing. If you do FHA or VA, the USDA has an amendatory clause. If when you sign that paperwork, it says you do not have to purchase this home if it does not appraise.
Ah, okay.
So one of the problems with that is the builder's going to say, then I'm not building your home.
Okay.
Because if you over improve the home for the development, they're going to make sure that you can handle the difference. And they're going to ask the lender, hey, do they have the money to be able to handle the difference with this?
Okay.
So it's important, generally speaking, the appraisals all in all come in at value or above value. But you need to make sure that when you're asking for your selections that you stay within the confines of those values of the development. Otherwise, you can over improve that home and now you're on the hook for the difference.
So I think what I'm taking away from that is one of the important questions when a buyer's going through the selection process is to ask the builder, what I'm asking for here, is this common, or do you see this as an over improvement compared to, many of my future neighbors?
Absolutely. It's really important to have that conversation, and it's important for the builder, the site rep, to know where they're going with these selections because everything has a dollar value to it. So all of a sudden, if they look up and they see that the house is, with all of the additions in the model and the square footage, that it's going to cost $350 to get this done, and they know they have had no values, no appraisals in that, or no sales in that community for $350, they need to call them on that and make sure that they're aware of this and that there's a difference, because at times they may accept a larger deposit because of it.
Okay. All right. Well, that's good to know. So what you're also saying, I think, when it comes to appraising, unless it's really over improved or the market has changed, for the most part, new construction appraisals come in right around the sales price.
Yeah,
Okay.
commonly. Yeah, I mean, does it happen at times where things come in slightly under? Yes. Does it happen sometimes where things come in much under? Yes. I had a couple that put in 2 master suites.
Ooh, okay.
It's rare that you walk into a home and you see 2 master suites, both with master bathrooms, both with the size, so it was a unique home. It was $90,000 above the appraised value. So the mortgage is not going to start until you get down to that appraised value. Remember, the mortgage starts on the lesser of the two between sales price and appraised value. So that's what it starts off of. If this house appraised $90,000 lower, that's what it did. They owed that $90,000 first, and then everything else got started. They were aware of this from the beginning, and they were in a position to be able to continue to move forward. So that was helpful that the builder caught that.
Okay, thanks, Bernie. So, Bernie, many buyers that are starting out this new construction purchase journey may have already purchased a home in the past using an existing home, which is probably more common. And so that's the experience they're used to, and probably the experience a lot of agents are used to. From your experience in working with a lot of new construction financing, can you tell us some of the differences between buying a new home and buying a new construction home?
Absolutely. One of the biggest things is the time waiting. There's a big gap in between the time that you started this process, going in and seeing the model home and, starting to sit down and do a lot hold, and then starting to make some selections, and then pulling the trigger on the contract, and then making all your selections, and then you're looking at a potential settlement date or time period. There's a lot of balls in the air for this. So, obviously, like I said before, permits being pulled, but the biggest one's weather. They cannot control the weather. And, sometimes it'll rain 5 days in a row and it's like, all right, well, today's sunny. We'll go dig my hole. No, place is muddy. Things are going to get stuck. It's just not going to happen. So they have to be patient on this because it's going to take some time. Believe it or not, they do want to build your home. They have your deposit. Their money's sitting on a line of credit. It costs the money every single day while it's on that line of credit. So they want to get this off their line of credit and sell you and build this home. The big part I would tell a consumer is to take good notes. Start from the beginning. What question did you ask? Who did you ask that question? What was the date of the question? Not only is it helpful should any discrepancies come up in the future, but also to remind yourself. There's a lot of times, I followed up with an email on a conversation and then going back 5 months, move forward 5 months and said, listen, this was the answer. And people don't remember it, so I forward them the email again. It's important that we know who we spoke to, when we spoke to them, what was asked, and what was the answer. Because, 6 months is a long time and things get forgotten during that.
Yeah, I can really see how that could happen. Even new construction representatives could change sites. They could change builders.
That's a good point. And then they're not privy to the conversation. So you want to be able to bring them in with good notes. And it's helpful. It maintains, your patience. It maintains your demeanor throughout the process of doing this because it's a big deal. It's really special. However, there's so many moving parts between selections, custom options, you watching this take place, the building, all of a sudden it's being framed. Now there's a roof. Now they put windows in, ... So there's a lot of things that go on, but you want to be specific because you're going to be in this home for a very long time.
All right. Thanks a lot, Bernie. This is really great information. So if I were to sort of recap, I would say being patient sounds like it's going to be, one of the most important things.
Yeah, completely. Save your relationships.
Communicate with your loan officer, your lender, throughout the entire process.
Yep.
Anything you are doing or thinking about doing, key life changes, to the extent of your car breaks down, your income changes, anything along those lines, don't make this a surprise at the end.
Absolutely. And one of the things I did not mention earlier is student loans. Someone may be actually through the process of going to school while still working. And if you started the process in May and then you get to September, a new student loan may kick in, which could talk about your debt ratio at that point in time. So you want to make sure the conversation is had. Hey, are you going back to school? Or, hey, I am going back to school. I'm going to take out the student loan. People think that just because the student loan is deferred means there's no payment. No, it's not the case. They will still attach a payment to your student loan, even though it is in deferment, which could disqualify you from purchasing that property. A medical bill could show up. You just want to be very clear about what's going on because you don't want to find out down the road after you've given the builder lots of money and then you're not able to buy this home that you built.
Okay. So communicate throughout, monitor your own situation, know your own situation, know where you are a borderline candidate for your mortgage in any way. Is it your income? Is it your credit score? Work to continue to work on those things that are important for your mortgage qualification. And then from a couple of key things that I took away from you, Bernie, was asking the right questions. And a couple of those questions are for your lender. Ask if they do a float down rate. If rates, maybe moving. Find that out up front. And then when it comes to the appraisal and protecting yourself from undervaluation, find out if the improvements that you plan to make by adding various features through the
especially custom
process.
features.
Custom features, right? Exactly. Custom features. Have a good conversation with the builder to find out if these are typical and customary so that you're not surprised if the appraisal comes in low, again, after you already have a significant investment into the property.
Absolutely. And they should know the values of the properties they've sold. So they will know whether or not that you've over-improved this home for the neighborhood itself.
All right. So I think we're really leaving with some great tips for anyone who is considering a new construction purchase. And one final question that I have for you, Bernie, is just around success stories. You've been in the business a while, you're, ingrained into both new construction and existing homes. Are there any stories that you can share or anything interesting that has happened, throughout this process?
The new construction portion, as with any type of financing, is special because in particular new construction, you've made all your selections. And people don't realize how many things you have to actually pick out when it comes to the home. You're not just picking out the type of model. You're not picking out the elevation, but you're also doing countertops and flooring and knobs and tile and, shower heads, all the stuff.
A lot of decisions.
I don't want those decisions. It's a lot of decision making, which is a lot of fun, but also at the same time, it can be stressful, but you want to see it come to fruition. So I love the fact of starting with somebody in May and then December comes around and they've seen what they've built, they've made happen over the course of their life. And now it's theirs. No one's ever slept in it before. No one's ever been in it before. It is your now home with the certificate of occupancy. That's actually my favorite part. And being invited to see the homes after they're completed, is awesome because you've built a relationship with everyone throughout this process because it is a long process. And you want to make sure that, there are no surprises or you can foresee any speed bumps or red flags down the road. You want to know that now so that way you can prepare people for them. But it is really special to do new construction and watch this happen from the beginning through the end because life happens quickly. So, take good notes, make sure you're on top of it, and then you can have a really good, successful transaction and keep your family very happy and stress-free.
All right. Well, Bernie, before we wrap up, I'm just going to ask you to leave your contact information, and anyone who is interested in getting financing for new construction in the areas that you represent, they can contact you.
Absolutely. My name is Bernie Doherty. I'm with Pike Creek Mortgage. My telephone number is 302-598-0136. My email is B as in boy, D as in David, OHERTY @PikeCreekLoans.com, and my NMLS number is 146770. And as always, thank you so much for having me.
All right, well, we're going to have you back for more great information in the future.
Great, thank you.
In this episode, we covered financing tips for new construction, where we learned about how to make sure that the lender's involved with any important changes that may take place with your income, your assets, or your credit, and that can ultimately save you thousands of dollars, whether it's by getting a better loan product, a better interest rate, or even protecting the deposit that you have on hold with the builder. So hopefully that information was helpful. As we wind down this episode, I also want to be sure that you are aware that you should bring your realtor along with you for your very first new construction visit. That way they can represent you throughout the transaction. They can help you with reviewing your contract terms to make you aware of what is customary versus what is unique to the builder's contract. They can also be your ally and your advocate throughout the process. Thanks for tuning in to this episode of Keeping It Real in Real Estate with Kathy Blakey as your host. For more information on this episode or others, visit www.keepingitrealinfo.com. There you can find information about becoming a guest speaker, episode notes, and contact information for the guest speakers. You can also connect with me on social media by using the key terms Kathy Blakey Realtor. Find me on Facebook, Instagram, LinkedIn, or YouTube. If you'd like to subscribe to this podcast, you can find it on iTunes, Google Play, Spotify, and more. Thanks for listening. As a disclaimer, this show is not intended to be used as a replacement for professional advice. For specific issues relating to your real estate transaction, please consult with your qualified realtor, mortgage broker, home inspector, or real estate attorney. Thank you.